Friends, thank you once again for tuning in. We are going to continue with our revision. Today, we want to look at revision in respect to financial reporting. This session specifically will want to look at a paper that was done in May 2015. That's on 28th May 2015, and this was on a Thursday paper. So we want to look at question 1. Don't forget, friends, we are looking at 28th May 2015 paper that was done, is a CASNEP examination that was done for financial reporting. That is section 3, or rather we can say part 2, section 3, financial reporting. So we go directly and look at question 1. Now, in question 1, as you can see it from the screen, the following trial balance was extracted from the books of Max Limited, a company quoted on the Security Exchange as of 31st March 2015. So we have a trial balance there. There is land and buildings, there is machinery, there is equipment, there is accumulated depreciation. On 1st April 2014, buildings, machinery, and equipment, we have the software, we have the inventory, we have the administrative expenses, we have 8% loan stock, we have the financial assets at fair value, we have the retained earnings, we have the salaries and wages, we have the maintenance of machinery, we have postage and stationery, there is 6% redeemable preference shares, there is ordinary shares of 20 shillings per value, there is the share premium interest on 8% loan stock, we have disposal of machinery, we have rent and rents, we have purchases and sales, we have dividends paid, accounts receivable and accounts payable. We have allowance for doubtful debts, bank and cash balances. We have allowance for doubtful debts, bank and cash balances, directors' remuneration, investment income, advertising, carriage inwards and carriage outwards. Additional information. 1. Inventory as of 31st March 2015 was valued at 504 million shillings, while the fair value of the financial assets was 185 million. 2. Software was acquired during the year and is being amortized over the 2 years. Amortization is classified as a cost of sales item. 3. Accrued administrative expenses and salaries and wages as of 31st March 2015 amounted to 11 million shillings and 42 million shillings respectively, while prepaid rent and rates amounted to 12 million. 4. A machine was sold on 1st April 2014 for 29 million shillings. The initial cost of the machine was 60 million and the accumulated depreciation was 16 million. 5. Buildings are depreciated at 2% per annum using the straight line method. Land comprises a third of the cost of land and buildings. Machinery and equipment are depreciated at 30% and 20% per annum respectively, using the reducing balance method. 6. Allowance for doubtful debts is to be increased by 4 million. 7. Income tax on the current year's profits is estimated at 58 million. Administrative expenses include under provision of tax relating to the previous years amounted to 3 million. 8. Audit fee amounting to 25 million is to be provided. 9. Expenses are to be apportioned as follows. Cost of sales, admin and distribution. You realize we have salaries and wages. There is 40% to cost of sales, 50% to admin expense, and 10% to distribution cost. Depreciation of buildings, 50% to cost of sales, 25% to admin expenses, and 25% to distribution costs. Depreciation of equipment, 100% to be allocated to admin expenses. Then rent and rates, 40% of it should be recognized as part of cost of sales, 30% of it should be recognized as part of admin expense, and not forgetting the remaining balance 30% to be recognized or apportioned under distribution costs. Required. A statement of comprehensive income for the year ended 31st March 2015. B, a statement of financial position as of 31st March 2015. Now, friends, one thing you need to remember from the required A, B is 10 marks each. Statement of comprehensive income as of 31st March 2015, that's 10 marks. Then a statement of financial position for that 1st March as of 31st March 2015 is also 10 marks. For the purpose of revision, we are also going to go further and maybe prepare a statement of comprehensive income for the year ended 31st March 2015. The fact that we were not required to do that, we are going to prepare that for revision purposes. Now, friends, look at this. From the required point of view, a statement of comprehensive income for the year ended 31st March 2015, then it means that our current financial year begins from 1st April 2014 and ends on 31st March 2015 of the following year. That's our current year. So the current financial year is starts on 1st April 2014 and ends on the 1st March 2015. It's important, friends. It's important to remember that point, because there are some items that we are going to be given, or there are items that relate to the previous year, there are items related to the current year. There are items that are going to act as our opening balances, and there are some items which are going to be our closing balances, especially as far as the trial balance is concerned, which is given as of 31st March 2015. Don't forget that, friends. Now, at that point, what we are going to do, the area of attack, first, we are going to look at the additional information. Or rather, we may first start with the trial balance, analyze the trial balance and look at some of the items. Or rather, we go back and immediately start with the additional information. We make the necessary adjustment to the additional information, friends. After making the necessary adjustment using the additional information, then we can now go back to prepare the financial statements. Those additional information are very important. As many as they are very important as you go each by each, friends. So don't forget that. Now, when we talk about the statement of comprehensive income, we are simply talking about where you are presenting the incomes. We start with the sales or revenue or turnover. We less the cost of sales. We get the gross profit. We add other incomes. We less the expenses. Expenses here, they are classified under functional head. Don't forget at this point, there are two methods of presenting the income statement for publication. One, that is where we classify expenses by function, that's which the most preferable. And we have where we classify expenses by nature. In this case, the most preferable, where we present expenses by function, is we identify the various functional heads, like the cost of sales, we have admin expenses, we have distribution costs, and we are going to recognize expenses under those various functional heads. This means that our working will be required. We need to determine the exact figure for the cost of sales. We need to determine the total figure representing admin expenses. We need to determine the total figure representing the distribution costs. We need to determine the total figure representing the finance cost. Don't forget, when it comes to the finance cost, friends, we have the interest on loans. We have interest on debentures. We also have dividend on redeemable preference shares. That is part and parcel of finance costs. We are going to come back to that again, explain it. Now, what we are going to do, these friends, we go back to the trial balance. We look at those items, we just identify them very fast, and then we go to additional information. Our key element is actually additional information. From the beginning, we have land and buildings. That is part and parcel of the property, plant and equipment. We have machinery, we have equipment, that is part of property, plant, equipment. The accumulated depreciation given there is actually the accumulated depreciation at the beginning of the current financial year. So we are going to take that one into account when we are going to determine the total PPE at the book, at the balance sheet date. We have the software, that's an intangible asset. We have inventory, that's on 1st April 2014. This means that that's our opening inventory. We are going to use it to compute our opening stock. If you're not given, we're going to use it to determine our cost of sales if you have not given the cost of sales. We have admin expenses, 8% loan stock, meaning 8% is the amount that we should be paying every year as interest. Then we have finance assets as fair value, that's long term. We have, if they are not indicated that that financial asset fair value is a long term, then that could be recognized as a current asset. Is a cash and cash equivalent. The retained earnings, that's the retained earnings at the beginning. We have salaries and wages. We have, that's an expense. It's part and parcel of admin expense. We have maintenance of machinery. We have postage and stationery. We have 6% redeemable preferred shares. We have owner shares, that's equity. We have the share premium, equity, interest on 8% loan stock. That's what must have been paid and accounted for. We are going to take that into account in computing the amount to be reported in the balance sheet as a liability. Disposal of machinery. We have, it means we must have disposed of machinery and we received 29 million. Then we have rent and rates. We have rent and rates without being told unless there is additional information. If there is no additional information, rent and rates will be recognized under admin expenses. But if there is additional information identifying it otherwise, then we use it accordingly. Purchases and sales, purchases will help us to determine the cost of sales. Then we have dividends paid. We have accounts receivable and accounts payable. Accounts receivable is a current asset and accounts payable is a current liability. Allowance for doubtful debts will offset our accounts receivable, but we need to confirm whether there was an increase or a decrease. Bank and cash balances, that's a current asset. Director's remuneration, unless there is additional information. Without additional information, that's directly a part and parcel of admin expense. We have investment income. That's our investment. We are going to recognize it as incomes in our income statement. We have advertising. Unless you are told otherwise, that should be recognized under selling and distribution cost. Carriage inwards, that should be recognized under cost of sales. Carriage outwards, that should be recognized under selling and distribution cost. Now, additional information. Now, when you go to additional information, friends, we'll want to read and apply it immediately. If there's a working that is necessary for the same, we do that working. If there's a working that we are going to do later using the same information, we mention that. Number one, inventory as of 31st March 2015 was valued at 504 million, while the fair value of the financial assets was 185 million. Now, don't forget this. When they have told you the inventory as of 31st March 2015 is 504, definitely that's the closing stock. And that inventory will be, apart from being used to determine the cost of sales, we are also going to use it in our statement of financial position as a current asset. We have been told the fair value of financial assets is 185 million. If you consider or you compare the financial asset at fair value at the trial balance is a total of 180 million. But when it comes to the additional information, we'll be told that is 185 million. So it means that there is an increase. It was 185, now it has gone to 185. It was 180, now it has gone to 185. So the 5 million is an investment income. That's an income we have received. So we are going to recognize the 5 million as part of the investment income. And at the same time, we are also going to recognize the 185 million as an non-current asset in the statement of financial position. 2, software was acquired during the year and is being amortized over 2 years. Amortization is classified as a cost of sales item. Now they have told us that it was amortized over 2 years. So this means that if you go back to the software itself, we have it as 100 in the trial balance. If you are amortizing it over 2 years, then you divide it by 2 to determine the amortization charge per annum. So 100 divided by 2, that's 50. So every year for 2 years, we are going to recognize 50 as an expense. That amortization, will be told, it should be reported as part of cost of sales. When you go to the balance sheet, we are going to determine the net book value of the software. We'll take the 100, we subtract the 50. And from the look of things, we are not amortized before. So this is the first time we are amortizing. So we are going to recognize 100 minus 50, and that's the 50 as an non-current asset. 3, accrued admin expenses and salaries and wages as of 31st March 2015 amounted to 11 million and 42 million respectively, while prepaid rent and rates amounted to 12 million. So from what we are seeing there, we have been told that there is an accrual. There is an accrual and there is a prepayment. Remember, when it comes to expenses, the element of accrual and a prepayment. Remember, an accrued expense will be recognized in the financial year that it was incurred. This goes to the accrual concept, where expenses are recognized when incurred, not when paid, and revenues are recognized when earned, not when received. So if there are some expenses as we are seeing here in note number 3, then those accrued expenses will be recognized as part of the admin expense in the current year. But at the same time, friends, at the same time, you remember, this accrued expense is a liability. It will be reported as a current liability in the statement of financial position as of 31st March 2015. There's also a prepayment. If we had made a prepayment, then we are going to reduce our expenses with that prepayment. If we reduce our expenses with that prepayment, then we get the exact expense that was incurred in that year. The prepayment will be reported, the amount prepaid will be reported as a current asset in the statement of financial position. So that one, I can use it. We are going to do it as a working and we use it later when we come to the conclusion of where we really need it most. Then, number 4, a machine was sold on 1st April 2014 for 29 million. The initial cost of the machine was 60 million and the accumulated depreciation was 16 million. Now that will take us to really account for this machine. I think this one we can do it on its own. I don't think whether there is anything else affecting the machine, but we know that we have depreciation on whatever on machine, and we know we have been told from note number 4 that the depreciation of not note number 4 but note number 5, that the depreciation of the machinery will be recognized as a part of cost of sales. Okay, now what we are going to do here, we are going to read note number 5 so that as we account for a machine, we also have read note number 5 well. Note number 5, buildings are depreciated at 2% per annum using the straight line method. Land comprises a third of cost of land and buildings. Machinery and equipment are depreciated at 30% and 20% per annum, respectively, using the reducing balance method. Unless otherwise, if you are not told the depreciation of machinery, or rather you are not told where to allocate depreciation of machinery, you will always know that depreciation of machinery should be part and parcel of the cost of sales. From additional information number 9, we notice that we have not been told about where to recognize depreciation of machinery. But so that means that we'll have to recognize, because the productive asset, we'll have to recognize it as part of a cost of sales. Now we use that information in note number 5, where we have been told that depreciation for buildings is 2% on a straight line basis, meaning 2% on cost. Land comprises a third of cost of land, meaning 2/3 is actually buildings. They have given you that because we don't depreciate land. Machinery and equipment are depreciated at 30% and 20% per annum, respectively, using the reducing balance method. Now, that's where we come in. That's where note number 4 will come in. So we have machinery. We are depreciating it at 30%. Now, combining note number 4 and 5, let's try to account for this machinery because we disposed of a machinery. Let me go to the, from the basics. At this level, I should not be going to the basics, but let me try to start from the basic down there. Let me try to see how are we accounting for assets according to IAS number 16. So here we go. We are saying that this is May 2015, question 1. Now we are saying that if you look at note number 4 and note number 5, they talk about machine, they talk about PP. So let me try to look at machine alone. Machine, let me call this working 1 working one. I am looking at machinery. So let me have machinery account. Then B, let me have provision for depreciation on that machinery. Then let me also talk about disposal. Friends, I'm just taking you down there. Is not at this level, we should not be doing this. But I'm taking you this so that we are able to get the concept well. So at the beginning, we have the balance brought down, which is at cost. Machinery from the trial balance, we have 840. Then the provision for depreciation, we have the balance brought down, friends. The balance brought down, that comes to 416. Disposal, we have disposed of. We have been told a machine was sold on 1st April 2014 for 29 million. The initial cost of the machine was 60 million. So we come and say the initial costs, come and say machinery, we have disposed. The initial cost was 60 million. You debit to a disposal account, you credit your machinery. We have been told that the accumulated depreciation of the disposed machinery was 16 million. So you debit your provision for depreciation. With the 16 million, we come and say the accumulated depreciation with the 16 million. Then we have been told it was disposed of at 29 million. You debit your cash, you credit, come and say cash proceeds. Then from there, we realize that we don't have another business. So the balances carried down here, I'll take my calculator and get this. We don't have purchase, there was no additional purchase. We have not been told anything about it. Then we also need to determine, apart from, there is the expense, depreciation expense for the year. We have to calculate that. Then we need to determine in our disposal account whether we made a gain or a loss. If it's a gain, it will be a balancing figure here. If it's a loss, it will be a balancing figure here. Now I take my calculator first. I determine the balances. That's 840. I subtract the 60. I'll get the 780. Provision for depreciation. Remember, we need depreciation expense. And we've been told that we are calculating these on a reducing balance basis. That is, on we are talking about 30%. 30% on a reducing balance basis. So I'll take 30% on this 780. So there is 780. There is 780. But you need to remember that the accumulated depreciation for the reducing balance basis, accumulated depreciation at the beginning was 416. So you have to subtract the 16 because 16 is for the disposed asset. So I'll take 416, I subtract 16, then on that is the figure that I will subtract from 780. So what I'm going to do is this. I'm going to say 416 minus 16. So what will I do there? So I'm saying 780 minus simply 400. I get 780 minus 400. I just get 380. Then I take 30% of that. Then I'm getting 114. Right? So 114. Now I can come and say 416 plus 114 plus 114 minus 16. I'm getting 514. The balancing figure in the disposal, we are taking 60, I subtract 16, I subtracted 9. I realize that it is it's a loss, so we must have sold it at a loss of 15. This loss, unless otherwise you're told, this loss will be recognized as part and parcel of cost of sales. Now we are through. Some of these are items that you could have worked without doing all this. But in our part of our PPE, we're going to take the 780 minus the 514, and that will be the book value in our statement of financial position as part of the property, plant, and equipment. Secondly, the depreciation expense of 114 will be recognized as part of cost of sales. Thirdly, we have a loss of 15. That loss of 15 will be recognized as part of cost of sales. So we should not forget these items. They're very important. Now we move on to buildings. You have been told depreciation is 2%. Equipment is 20%. That's no problem. We are going to deal with it later. Additional information number 6. Allowance for doubtful debts is to be increased by 4 million. So the 4 million will be reported as an expense, and it will be reported as part of admin expenses. That's 4 million. Then number 7, income tax on the current year's profit is estimated at 58 million. Admin expenses include an under provision of tax relating to the previous years amounted to 3 million. So first and foremost, we have been told that the tax for the current year, the estimate for the year is 58 million. Out of 58 million, we may not have paid anything. We confirm that from the trial balance. In the trial balance, I can't see any tax paid. So the 58 million is the tax expense for the year. At the same time, it was never paid. It will be reported as a current liability in the statement of financial position. That's all. Then we have been told that there's some admin expenses like overstated. It includes a provision of the previous year. It includes a provision, an under provision of the tax in the previous year of 3 million. So we are going to reduce our admin expense by 3 million. Apart from that, the 3 million will be recognized as an expense. If you under provide for tax, then it means that you have under recognized an expense. So we must have overstated. If we don't account for that, then we'll overstate our profits, or we'll understate our tax. So we are going to adjust our profits by the total tax. Apart from the 58 million, there will also be the 3 million, which is an under provision. If it was an over provision, we could have reduced our tax expense to that effect. 8, audit fee amounting to 25 million is to be provided. Remember, it has not been provided. This means that we are going to recognize it as admin expense and at the same time as accrued, because it has not been paid as a current liability. So number 9, expenses are to be apportioned in accordingly. Sales and wages, depreciation, those items, rent and rates and what have you. Now, where do we start from? We want to start from maybe recognizing the cost of sales. We need to compute the cost of sales. So we come and now do another working here. So working number 2, now this is cost of sales. Let me say costs of sales. So we start with the opening stock. Then we talk about purchases. We talk about carriage. I saw carriage inwards. We less closing stock. As you must have seen, we also had depreciation. We had loss on disposal. Now let me go back first and bring in those items before we get into so many other things, maybe can bring a confusion here. So we start with the opening stock. The opening stock from the trial balance, friends, I can see it as a figure of 349. We have the purchases. We go back to the trial balance once again. The purchases, friends, as I can see there, the purchases is 2148. Our figures are millions. Don't forget. Carriage inwards. Carriage inwards is a figure of 34. Closing stock. We were told in addition information number 1. Remember, note 1. We're given note number 1. That's 504. Let me go back to addition information first to the trial balance and see whether there is something that need to be recognized under cost of sales that we have not adjusted. We are not seeing anything. I'm trying to look at that. Fine. From the trial balance, we don't have specifically something to be recognized as cost of sales that we have not adjusted. Addition information number 1, that's fine. We have used it. Addition information number 2, there's not, yes, there is amortization of the software. This is note 2. This is note 2. So we are going to amortize it over 2 years. That's 100 million over 2 years. So we have this as 50. That goes without even a calculator. Then 3. There is accrued admin expenses, salaries and wages. There is also a prepayment of rent and rates. Now you need to know that from addition information number 9, there is rent and rates that we are going to apportion. There's also salaries and wages that we must apportion. So we'll come back to them later. Friends. I'll look at note number 5. Note number 4, sorry. Note number 4, we had done some working here. So we know that there is a depreciation on machinery. We could have just worked it here. We could not have done what we did here. Remember, I could have just come 30%, 780, or rather, before I even start with 780, I just say in small brackets is 840. I subtract the one that we disposed of, that's 60. Then I subtract accumulated depreciation, which in this case will be the 416 minus the 16. That's what we could have done. Instead of doing all this, so we could have just simply said 840 minus 60 minus 416. Then we multiply that percent. We could have got the 114. Then I'm still going through the addition formation. Number 5, we may come back to it. 6, allowance for doubtful debts, that's for admin. 7, we'll come back to that. 8, that's for admin. Number 9, so salaries and wages. Salaries and wages, 40% is cost of sales. This means that we go back to our salaries and wages as per the trial balance. From the trial balance, salaries and wages, friends, from the trial balance, salaries and wages, I'm seeing a figure. I'm trying to, that is salaries and wages is 298. So as per the trial balance is 298. But we know that we are taking 40% of that. Then From addition information number 3, there is an accrued salaries and wages of 11 million. No, it's not 11 million, it's 42 million. So I'll add 42 million. From that point, I look at anything else affecting salaries and wages. There's nothing else. So at that we say 40% of which. So 40%, we are saying 298 plus the 42 by 40%. I'm looking at it as 136. Then we move on. We still move on and say in our note number 9, depreciation on buildings. There is depreciation on buildings. We should only apportion 50%. So what's the depreciation on buildings? Depreciation on buildings, now we go back to note number 5, We go back to note number 5. We are told that we are depreciating buildings at 2% on a straight line method. And we need to know exact building because the figure given there is land and buildings. From note number 5, we have been told that land comprises of 1/3 of the cost of land and buildings. This means that 2/3 of land and buildings, 2/3 of land and buildings is actually buildings. 2/3 of land and buildings is buildings. So we come and say 2%. 2%, friends, is the depreciation rate. So you multiply that with the 2/3 of land and buildings. Land and buildings is 1,800. Remember, the 50% is a portion of depreciation expense of buildings that to be recognized under cost of sales. 2% is the depreciation rate on buildings alone. 2/3 is the value of buildings alone because the total land and buildings is 1,800. 2/3 of that, 1/3 is the land, definitely 2/3 is the buildings. So 2/3 of 1,800 is the buildings. So you take the 2/3 of 1,800 and then 2%. So I take my calculator there, friends. Come and say there is 2% by 2/3 of 1,800. Then I multiply the 50%. That comes to 12. That's important. So the 2% there, as we have said, 50%, 2%, 2/3 on 1,800 is coming to 12. We go further and look at still note number 9. There's depreciation of equipment. Depreciation on equipment. We have been told or advised that depreciation on equipment is not going to be recognized in cost of sales at all. Then we go to rent and rates. We have been told that 40% of rent and rates to be part of cost of sales. So we go to the trial balance. The trial balance, rent and rates, friends, is a figure that I'm trying to locate because I'm standing. I'll get it as 282. So there is 282, and we have been told we are only allocating 40%. So 40% of 282. But if you go to addition information, number 3, we have been told that there is a prepayment of rent and rates amounting to 12 million. So you're going to subtract 12 million. That's what we have been told in note number 4, note number 3, sorry. So I'm saying 282, you subtract the 12, then 40% of that is 108. From that, friends, there is nothing else that should be adjusted now in our cost of sales. We are through, so we can get the total figure for our cost of sales. What will be our total cost of sales? So I come and say 349 plus the 2148 plus the 34 minus the 504 plus the 50 plus the 114 plus the 136 plus the 12 plus 108. That comes to 2457.